Chapter 1 is an introduction to accounting and business in general, and we'll get started with the objectives. Every chapter is going to have a list of objectives at the beginning, and that is just a way that they have taken the chapter and broken it into smaller, more easily to understand sections. Okay, this chapter actually has a total of 6 objectives, but we're only going to focus on the first 5. So we'll start out with objective 1, which is describe the nature of a business and the role of accounting and ethics in business. So it says that a business is an organization in which basic resources or inputs such as materials and labor are assembled and processed to provide goods or services to a customer. The majority of us know what a business is. This is just kind of putting it in actual words for a definition. Okay. The text also defines accounting as well, but what we want to first look at is that businesses have a couple of objectives. The first one is always to earn a profit. Nobody goes into business to lose money. So the majority of businesses are out to earn a profit, and profit, of course, is the difference between the amount of things that we receive from customers, which we hope is cash, and then the amount that we pay out for goods and services. There are 3 types of businesses. We have service businesses, merchandising businesses, and manufacturing businesses. Then we'll talk about accounting. Accounting is an information system that provides reports to users about the economic activities and conditions of a business. Accounting is also normally known as the language of business. Ethics is extremely important in business and in accounting, but we'll focus on the accounting portion of that. There are reasons that ethical codes are necessary. It says the reason why is ethics, accountants are privy to a variety of private and often sensitive information about businesses. Without these ethical codes, the accountant can be in a position to impact the business futures in a significant way, either positively or negatively. So this trusted relationship between businesses and accountants require that the accountant live by these code of ethics. And we've been kind of forced into this code of ethics, unfortunately, by things that have happened in public businesses that have required us to actually write down what an accountant's ethics are or should be. We also here at Wayne Community College have a student code of conduct, which is an example of ethical codes for students, and everybody should know those. One of the main ones that comes up a lot is student integrity, or essentially cheating. Do you know what is considered cheating and what is not considered cheating? And our student code of conduct is actually listed in our college catalog for everybody to be aware of what would be considered cheating. Okay, one of the things we must know is that accountants do more than just prepare tax forms. Okay, there are lots of opportunities for accountants out there. Okay, we have opportunities in public accounting, and we have opportunities in private accounting where a person may work for an individual business. And some more ideas are listed in your textbook as well. And this is some of them. Okay, so next we'll move on to objective 2, which is to summarize the development accounting principles and relate them to practice. Okay, so this objective introduces the Financial Accounting Standards Board, or FASB, and the Generally Accepted Accounting Principles. It says FASB sets the standard that governs the rules for financial accounting. These rules are defined as GAAP. So all accountants have certain rules and regulations they must follow, and those are GAAP. So we say, are you following GAAP, which is Generally Accepted Accounting Principles? They also have an International Accounting Standards Board, and the United States is trying to move towards international accounting standards. We're trying to integrate both United States rules and international rules, and the reason for that is because we are a global economy, and so if we want to be able to invest in businesses that are outside of the United States, we have to be able to understand their financial reports and make sure that they meet when we are comparing them to United States companies or American companies. We need to be able to make sure that we're comparing apples to apples there. So it has not happened yet. The United States have been dragging their feet, but we are leaning towards integrating both American rules and these international accounting rules, so that the world in general will follow the same accounting principles. So additionally, this objective introduces the business entity concept, the cost concept, the objectivity concept, and the unit of measure concept. Okay, these are 4 principles that govern how accounting data is accumulated. Accounting data would be inconsistent from company to company if standard procedures were not followed, and so that's why we have these different rules and concepts in place. Okay, the business entity concept can be illustrated by one question. If an individual owned a dry cleaning business, a video store, and a gas station, how would the owner know the profitability for each business? And the answer is by keeping separate accounting records. So we have to not only keep our personal information separate from our business, but we have to keep the individual businesses separate from each other as well. Okay, we have a few different types of businesses. There's like 4. We have a proprietorship owned by one individual. We have a partnership, which is similar to a proprietorship except it's owned by 2 or more. We have a corporation, and this is they're organized under state and federal guidelines, and they are a separate legal taxable entity. This information that I'm going through on the slide is also in your book. And then finally, we have a limited liability company, and this combines the attributes of a partnership and a corporation. All right, the cost concept. This concept can be explained through the purchase of like a new truck for a business. You'll recognize when you go to buy a new truck that the sticker price means nothing in the purchase of the truck. It's just really the sticker price, I hope, if you're doing it right, is the starting point for negotiations. Okay, you can identify several different types of prices throughout the purchase process. We have the sticker price, the salesperson's offer, the offer that you give, the tax value. However, none of these matter. The only amount that matters is the price that the business pays for the new truck. The original purchase price is recorded and remains on the books of the company until the truck is disposed of. So that's the cost concept. Understanding that we only record what we paid for it, not what its value is, not what we could have got for it, not what we should have got for it, but what we actually paid for it. I don't care if you bought a piece of land from your uncle and it was worth $1 million and you only paid $1, you record it for $1 because that's what you paid for it. The objectivity concept requires that we base it on real evidence. Okay, so what's the real evidence? The real evidence is the sale, the exchange of cash. Okay, the sales receipt, the purchase order, those types of things. And then finally, the unit of measure concept just means that we record everything in dollars. We don't make up our own money system. Okay. So that's objective 2. Objective 3 states the accounting equation and defines each element. And this is extremely important. This is the basis of all your other chapters that are to come. Okay, the accounting equation starts out with assets. Assets are resources that are owned by a business. Liabilities are debts that are owed by the business. And then finally, stockholders' equity or owner's equity. Stockholders' equity or owner's equity is a little bit harder to understand, but this is the owner's residual interest. And so, in other words, it's what would be left if the assets were used to pay off all the business's debt. Anything left over would go to the owner. Okay, and so when putting these 3 things together, we end up with the accounting equation where assets equal liability plus stockholders' equity. And so here's another way to look at it. Again, assets are resources owned by a business. Liabilities are debts that are owed by the business. And then stockholders' equity is anything that's left over goes to the owner. Okay, objective 4 says describe and illustrate how business transactions can be recorded in terms of resulting changes in the elements of the accounting equation. Okay. So a business transaction is an economic event or condition that directly changes the entity's financial condition. Okay, so anything that will change our accounting equation is a business transaction. So we have a few rules that we can go by. Okay, the accounting equation must always stay in balance. So transactions may require additions to both sides, subtractions to both sides, or additions and subtractions on the same side. Doesn't matter how you do it, as long as your accounting equation remains in balance. Revenues represents receipt of assets, such as cash or an account receivable, for goods sold or services rendered. The receipt of the asset from the investor is rewarded with capital stock. Okay, so we can have revenue from sale of merchandise, and we record it as a sale. Other examples of revenue include rent revenue, interest revenue, those types. Revenues is recorded when they are rendered or when they are earned, and not when the cash is received. So if we haven't received the cash, then what we get is an accounts receivable, which is a claim against a customer. All right, so we should note some more of the following things. The effect of every transaction is an increase or decrease in one or more of the accounting equation elements, and that's how we keep it in balance, by having one or more. Two sides of the accounting equation are always equal, and stockholders' equity is increased by amounts invested by stockholders. Stockholders' equity is increased by revenues and decreased by expenses. And expenses are costs that are incurred in generating revenue. Stockholders' equity is decreased by dividends paid to stockholders. And retained earnings is the stockholders' equity created from business operations through the revenue and expense transactions throughout the years. Okay, so stockholders' equity, this is a snapshot of your stockholders' equity. We have stockholders' investments increases stockholders' equity, dividend and expenses decrease it, and revenues increases it as well. Okay, and finally we have objective 5. This is describe the financial statements of a corporation and explain how they are interrelated. So we have 4 financial statements that are interrelated, meaning that we have to do them in order because we need data from one to be able to do the other. Okay, so we have 4 different financial statements. We have the income statement, statement of owner's equity, the balance sheet, and these are the 3 that we will focus on in this class. And then we also have a statement of cash flows, which we don't actually require you in this class to learn how to create. Okay. So income statement will report revenues and expenses, and this is based on the matching concept. This means that we have to match our expenses incurred in the same period that we got the revenues from those. And our income statement will generate hopefully a net income, meaning that we've earned money, meaning we've had more revenue than expenses, or if not, then a net loss. That means our expenses were larger than our revenue that we earned. We are going to use that net income or net loss to create our retained earnings statement. And then finally, we use our ending retained earnings balance to help us generate our balance sheet. Our balance sheet is essentially the accounting equation. Assets equal liabilities plus stockholders' equity, and they must balance. And then finally, just understand what the statement of cash flow is. It is literally showing where our cash came from and went to during the time period. And it has 3 sections. Operating, which is our normal stuff that we do for our business, investing, and then financing activities. Okay, and this is a brief overview of Chapter 1.